This fintech stock is growing over 70% per year while potentially revolutionizing online payments. And unlike most high-growth stocks like Upstart or SoFi, this company's stock price has only increased 55% this year, potentially giving us an opportunity to buy in before its valuation shoots up. Hey everyone, and welcome to Fintech. The company we'll be talking about today is Affirm, a fast-growing fintech stock that has only IPO'd in the last year. We're going to go over Affirm's background as a company, talk about what they actually do, and look at their latest earnings numbers to see if this company has the potential to 10x in the near future, or if its growing popularity is just hype. Finally, I'll offer my thoughts on their future and let you know whether or not I personally am investing in them. So hit the like button if you want, and let's start with a brief overview of Affirm as a company. Affirm was founded in 2012 by 4 co-founders as part of another company called HVF. Affirm was later then spun out into its own separate company once it started showing promise as a fintech. Affirm's CEO and one of the founders is Max Levchin, a genius software engineer who helped build the original fraud detection system for PayPal. In fact, Levchin also helped found PayPal as part of the PayPal Mafia, alongside several other high-profile entrepreneurs, including Peter Thiel and Elon Musk. Affirm is known for offering no hidden fee loans for consumer product customers. They might partner with a big company, like say Peloton, and when someone goes to check out on Peloton's site, they see an option to pay over time using Affirm. This is a concept known as buy now, pay later, and it's not unique to Affirm, but the company is seeing massive growth in this area. And while buy now, pay later has serious competition from companies such as Square with Afterpay or Klarna, Affirm is unique in just how long it allows customers to space out their payments. Lots of retailers offer to break up payments into chunks of 4 separate payments. PayPal calls this their Pay in 4 product. Klarna has the same thing, and so do companies like MasterCard. But Affirm allows customers to pay off purchases over a much longer time. We're talking 12, 24, or 36 months. The fact that Affirm is willing to take on the risk of holding an unsecured loan for 36 months is what is allowing them to win over big merchants like Peloton, Shopify, and even Amazon. So merchants are happy because longer payment schemes mean more people can buy their stuff, and customers are happy because it's one more option on how to pay. This looks like a win-win, and that's definitely the story that Affirm pushes in their investor presentation. But in addition to their existing winning product, Affirm is also very clearly focused on the future. In 2019, Affirm launched a new app to allow users to shop almost anywhere using a virtual card. So rather than needing to partner with a merchant, customers can buy stuff directly through their card. The app also acts as a base for a much larger ecosystem that Affirm is starting to build. They have the merchant marketplace built in, which accounted for 1/3 of their total transactions in 2021, 29% to be exact. They offer a savings account, they plan to let you buy and sell cryptos in the app, and they plan to launch their own Affirm debit card, which they think will completely revolutionize personal finance for Gen Z. But we'll talk about that a little more later. Affirm clearly sees themselves like a SoFi or a Square. They want to become a full-on fintech company, using their buy now, pay later as a way to attract cheap customers early on. Their story right now and their plans for the future sound pretty good at first glance. But rather than taking that story at face value, let's first take a look at Affirm's numbers, because numbers usually tell the real story. As a payments processor, one metric that Affirm uses is GMV, or gross merchandise value, to see how much product sales they helped facilitate. That number hit $2.5 billion in their last quarter, putting the total up 106% year over year. Just that number alone shows how quickly Affirm is moving into the payment space. But if we were to exclude Peloton, which makes up a substantial portion of their overall sales, their GMV was actually up 178% year over year. That's nearly a triple in the total products payments processed through their platform. They also grew their revenue this past quarter to $252 million, up 71% year over year. This would put them in the same category as SoFi, which grew its own revenue 74% year over year. And if we ignore provisions for credit loss and pull out transaction costs, this puts their revenue at 7% of the total gross merchandise value, showing that they have decently strong unit economics as well. And by the way, to make this video, I read through Affirm's entire earnings call transcript and presentation, and it was not short. So if you appreciate that kind of effort, please just hit the like button and let's continue. But even more useful than these dollar numbers is the growth the company saw among both merchants and consumers. Their number of active consumers hit 7.1 million this quarter, up 97% year over year. And in addition to increasing their total number of consumers, each individual also used Affirm more this year than last year, on average 2.3 times per year, which is up 8% year over year. Growing their user base will be super important when they start offering more products, similar to how SoFi is using their own sales funnel to capture users. Although comparing SoFi's sales funnel from their app to their lending business versus Affirm's funnel from their buy now, pay later product to their app, I think SoFi actually has the edge here. SoFi is mainly focused on college-educated young adults who will likely get richer over time. But I kind of question if the type of people using Affirm's buy now, pay later will be richer in the future. So Affirm may not get the same kind of long-term value out of each of their users as SoFi will. Affirm's number of active merchants absolutely exploded this quarter, up 412% year over year to 29,000. This is extremely important, especially when we think about Affirm's competitive advantage. What is their advantage? Their business model isn't very unique. We already talked about how Afterpay and Klarna do something similar. The company uses AI for fraud detection, but at this point, that isn't really unique either. And the company doesn't really talk about any advantage that AI gives them in measuring the risk of their loans like Upstart would. No, it really seems like the competitive advantage is their relationships with merchants. The fact that more and more merchants are signing on with Affirm, including amazing companies like Shopify or even Amazon, shows that Affirm has what it takes to bring merchants on board. But to temper that a little bit, while leadership can brag about having a 5-fold increase in merchants using Affirm and call out big names like Williams-Sonoma or Dick's Sporting Goods or Neiman Marcus, most of the 23,000 new merchants onboarded came from their new Shop Pay installments, which basically allows any merchant on Shopify to add the option to check out using Affirm. The only reason I call this out is that there is a risk that if Shopify, for some reason, decided to block Affirm on their platform, they wouldn't lose one merchant. They would lose thousands. But now looking at their expectations for next quarter, excluding Peloton, they expect their GMV growth to be around 70 to 75%. They also expect revenue of $1.16 billion to $1.19 billion, representing year-over-year growth of 33 to 37%. So two things here. Number one, that revenue growth rate is way slower than the 71% growth that they reported this past quarter. If they actually hit those numbers, it would represent a huge deceleration in growth and would put them solidly outside the realm of hypergrowth stocks. Of course, they did beat the high end of their guidance for this past quarter by 12%, so maybe we'll see a similar beat next quarter. Either way, they're probably sandbagging at least a little bit here. They also expect to see revenue less any transaction costs at $555 million to $570 million. If we were to use that to calculate a price to sales ratio, it puts the company at a PS ratio of 57 to 59. That's fairly high and much higher than the ratio you'll see if you just Google Affirm's price to sales ratio. But as long as they're growing at over 50% per year, that's probably an okay number. Any slower growth, and that is way too expensive. We also saw the company massively ramp up their sales and marketing expenses this past quarter, while decreasing investment in technology and data analytics. But on their earnings call, leadership says that they do plan to invest in technology going forward. So overall, the numbers look pretty good. But does Affirm have the long-term potential to 10x its market cap? And what risks do we need to look out for if we want to invest? So we already talked about Affirm's competition from Afterpay, Klarna, and PayPal. But we are going to want to keep an eye out going forward to make sure none of the larger fintech companies are able to copy what Affirm has achieved. As great of news as it is for the company that they got Amazon as a merchant, it would be just like Amazon to launch a competing product to Affirm and then just crush them with sheer size and money. One thing that was reassuring on the call was the CEO saying, Affirm's roadmap for new merchant services is very long. We see natural product expansion opportunities wherever access to capital, risk, or complex engineering requirements prevent merchants from delighting their customers. Basically, Affirm isn't scared of getting into new areas or new product categories, and they don't see the edges of their total addressable market being an issue anytime soon. Which kind of leads into an area that I mentioned earlier, Affirm's potential debit card product. Only this isn't a normal debit card. Young consumers more than ever are scared of credit. So rather than using a credit card, they use debit cards. Affirm hopes to capture those customers by offering their own debit card product. But with that debit card, the consumer can also use the Affirm Debit Plus card in place of the regular debit card. It can connect to any existing bank account, and once you put something on the card, you can use the Debit Plus companion app to turn any eligible transaction into an Affirm pay over time product. And since it's a software card, you can push updates to it over time. I could see this type of product catching on very quickly and kind of luring people who are scared of credit into using it. But wait a minute, isn't Affirm's mission statement to build honest financial products that improve lives? From a personal finance perspective, buy now, pay later is a horrible idea. And I genuinely can't think of a single use case where it actually benefits someone financially in the long run. 45% of people who use buy now, pay later do it because they can't afford to buy something. And nearly 20% did it because their credit cards were already maxed out. This was one area that made me pause with Affirm. It's one thing to offer products that might hurt someone financially. Customers are adults and they can make their own choices. But it's another thing to do the opposite of your stated mission statement. It makes the whole thing feel very untruthful. And it makes me question other things the company's leadership is saying as well. For example, throughout the earnings call, leadership kept saying, "This financial metric looks great if we exclude this part of it." I counted them using the word excluding 12 separate times in the call. And that's fine if you're excluding a one-time event that kind of skews the numbers, but that shouldn't be a common thing. So next quarter, I will be watching very closely to see if this is a pattern or if it genuinely was just an unusual quarter. If it turns out that leadership is misleading investors on their earnings call, I don't care how great the company is, I personally would not own them. But we'll have to wait and see on that. The last major risk is probably the most obvious one: interest rate risk. Unlike a company like Upstart, Affirm keeps a lot of loans on their balance sheet, up from $2.2 billion in 2020 to $4.7 billion at the start of the fourth quarter. Collecting interest on these is a core part of Affirm's business, but it also opens them up to fluctuations with interest rates potentially rising or people just not paying off their loans. Unfortunately, I'm not an expert in this area, so I don't really know how to quantify those risks very well. But we do have to remember that that risk is there. So based on all that information, what do I think of the company? Well, I like the story of a fintech starting from a base of strength, capturing customers cheaply through their integration on merchant sites, and then expanding to take on more and more of those users' personal finance needs. I also think they have a really strong monetization strategy for their future debit card. And overall, their numbers look pretty good. The risks that I laid out from both competition and interest rates are obviously big deals, but they're also the kinds of risks that if you watch them closely, you should be able to spot any issues coming a little ways down the road, letting you sell out before they become too big of a problem. The only thing that really gives me pause is whether or not the company's leadership is really being honest. Some of the things they said in the earnings report struck kind of a strange note, and their mission statement seems to be more about marketing than an actual guiding vision for the company. Plus, anytime a company's investor portal is a little bit too slick, it makes me question if they're just trying to convince people to invest. Not that those are necessarily real issues. I had the same reservations about Palantir back in the day, and I actually invested in them for a while. So what am I doing personally? Well, I don't actually know. This is a company I could see myself investing in or not, and I just haven't decided yet. I'll probably make an update video when I do decide, but in the meantime, if you want to be the first to know, you can follow me on Patreon where I post all of my stock trades in near real time. So let me know what you think of Affirm and if you think these are real issues or not. Don't forget to like and subscribe, and I'll see you next time.